right now we are at a decision-making point and very close to a recession. And I'm worried about something worse than a recession.
Hedge fund manager and billionaire Ray Dalio has issued one of his biggest warnings yet. And while a lot of people are getting liquidated out of their crypto positions with that flash crash, causing the most insane dip in the crypto market, well, Donald Trump just comes out and says, everything's going to be fine with China. Highly respected President Xi just had a bad moment there. He doesn't want a depression for his country, neither do I. The USA wants to help China, not hurt it. And now the markets are ripping to the upside. So a lot of people are wondering, should they sell their crypto now? Should they hold? Are we going higher? And what's about to happen next? Well, in this video, we have to share what Ray Dalio has to say. Because even though Trump is a businessman, he's a politician, and politicians can get you wrecked. So I like to listen to people who have the results that I want, not just random influencers on social media who are going to shill me some random coin and then dump it 10 minutes later. So in the macro, those who bought the dip did get historic entry points. However, in this video, you're going to see when the market is going to top out based on the macro business cycle. And we're diving deep. We're going to jump into the NASDAQ analog, analyzing the business cycle framework, Ethereum structure, a few different paths to the top, and determining what path we're on right now so you can maximize your gains before the crash happens and protect your capital when it's finally taking place. So comment 777 if you're feeling blessed, if you're feeling bullish, and as always, if you're going to become the first millionaire in your family tree, confirm it by tapping the subscribe button. Let's run it.
If this isn't handled well. A recession is 2 negative quarters of GDP, and whether it goes slightly there, we always have those things. We have something that's much more profound. We have a breaking down of the monetary order. We are going to change the monetary order because we cannot spend the amounts of money, so we have that problem. And when we talk about the dollar and we talk about tariffs, we have that. We are having profound changes in our domestic order, how ruling is existing, and we're having profound changes in the world order. Such times are very much like the 1930s. I've studied history, and this repeats over and over again. So if you take tariffs, if you take debt, if you take the rising power challenging the existing power, if you take those factors and look at the factors, those changes in the orders, the systems, are very, very disruptive. How that's handled could produce something that is much worse than a recession.
All right, bull runners, welcome back to the channel. Now, before you consider selling all of your crypto, I want you to consider what I'm going to share with you in this video, because the data points that I'm going to reveal are pretty shockingly conclusive. Because on CoinGlass right here, these are the top bull market peak indicators that basically tell you when it's time to sell at the top, and it aggregates them all together. And if all of them were to be flashing, it would say 100% sell. So right now it's showing hold 100% because 0 out of 30 top indicators are flashing. Now, some of them are getting close, you know, like the Bitcoin dominance here, anything greater than 65%. And we're right now just 5% away from that, with Bitcoin absorbing the capital after the flush from the altcoin market as altcoins got hit even harder. And then Bitcoin's long-term holder supply is pretty close at 88%. But the fact that none of these are flashing show that we still have higher to go. So then the next question becomes, okay, how much higher do we have to go? And then the question after that is, how longer do we have to go before the crash takes place? So let's discuss it. But before we do, I made this post in Discord yesterday when Ethereum was at 3,793, giving a couple scenarios, because my thought process on it was that the altcoin market, you know, is going to make a recovery off the lows because of how oversold we were on key indicators like the relative strength index, the MACD, the stochastic RSI, and Ethereum is like a weather map for the altcoin industry. So Ethereum would either make an aggressive recovery from those levels or form a bullish divergence as it consolidates a little bit further. But nonetheless, this is what I pointed out on the chart here, comparing back to even August of this year when we saw this bullish divergence on both the relative strength index and the MACD forming higher lows. And so I was expecting a breakout for Ethereum from those levels. And sure enough, that's what happened. And now Ethereum is at $4,131. I even said this in my video one day ago.
So this drop is about 27%. So yeah, it's aggressive, but I think this is going to prove to be a great entry point over the next few weeks for people, because look at the RSI. We're at 19 right now. And so I think this is going to make an aggressive recovery on out of here. So when you watch this video, again, I'm not telling you to buy because this is the riskiest industry to be in, but usually when we see these liquidations, we see aggressive buy-ups. For example, look at COVID's crash right here, this massive red candle that took place. Then the dust settled for a little bit while the relative strength index bounced from down here at like 24, and it started to make a recovery on out of here, and their recovery took a little bit. So we could see some type of recovery like this, but nonetheless, I think we're going to have a recovery on out of these levels. We'll see how long it takes before Ethereum moves, but I think we're going to make a new all-time high by the end of the year. Nothing's changed here.
Now, if we look at Ethereum's price chart, my personal belief based on the data and what I'm seeing right now is I think Ethereum is going to a new all-time high. Very similar to what happened back here after this flush out when Ethereum dropped from $3,800 to $3,300, because we see this happen time and time again after an uptrend. And this is why I've explained what bearish divergences and bullish divergences are and how to spot them on the chart, because this was just a big bearish divergence on the left-hand side of the screen for Ethereum. You can clearly see on the left hand, the price chart was making higher highs right here, whereas the relative strength index was making lower highs after the highest high. So the RSI goes up to 85, then we put in a lower high in the RSI to about 80, and the price chart puts in a higher high. Then we put in another lower high on the RSI, whereas the price chart puts in another higher high. Then we put in another lower high on the relative strength index, whereas the price chart puts in another higher high. So this just means that momentum is slowing down from bullish momentum, and then eventually there's a correction before either a trend reversal or a continuation in the uptrend. So this was a short-term correction before a continuation. And when these corrections happen, they typically liquidate the leverage traders that have their stop losses set at key levels right below these wicks. So for example, what a trader would have their wick at is right here, or have their stop loss at is right below this wick at like 3,498, maybe a little bit below that, even this wick right here. And as you can see, the price chart, when it crashed below both of these levels, stopped everyone out, and then reversed back to the upside and back tested this key support on the way back up to the upside. So there's a few ways that you can play this out and trade this. It's basically when these divergences are taking place, you're not buying into them, right? You don't want to be buying into a higher high on the price chart while a key indicator makes a lower high, because you're just buying the peaks. And also at the same time too, you don't know where the low is going to be in after we experienced higher lows on the relative strength index. For example, look at the bottom of the screen on the left here. You can see the lowest low on the relative strength index is right here at 23. The price chart was right here at $3,500 for Ethereum. Then Ethereum just continued to make these failed recovery rallies in this downtrend. We rallied up, and then we came all the way down here to $3,400. The relative strength index puts in a higher low at 25. And so that's technically a bullish divergence, but like I just mentioned with the bearish divergence, we can make 3, 4, sometimes 5 or more higher highs, while the relative strength index makes 3, 4, 5 or more lower highs. And it's the same thing for a bullish divergence, because we made, a third lower low, and the RSI made a third higher low, or a second higher low right here. So this could have technically continued down, and we could have made another higher low on the RSI and another lower low on the price chart. So you don't need to know, and this is a key to really understand here, and I want to focus on this first before we cover everything else in this video, and you can take this with you for life, even to the bull market peak, and understand this, is you never know where the low is going to be when you see bullish divergences, but when you see a reversal take place and you see key levels being retested like what we've seen right here, you can then get more aggressive on the upside, because you're either getting aggressive on the downside. Let's say you're buying this dip right here, but then you have to deal with the anxiety, the stress, and the panic as the market keeps on dipping. Then you buy the dip, the market keeps on dipping, versus waiting for the recovery on the other side and a key back test. Notice how this level right here on the back test at $3,500 is the exact same level back here in the downtrend, but you're not dealing with the stress of wondering if your whole entire position is going to go to zero during the downtrend. I know, like, even the experienced traders might feel this way because emotions are fickle, whereas logic and data is something that we want to base our investing decisions on. So right now for Ethereum, we saw something similar happen on the 1 hour time frame, where we saw this bullish divergence playing out. Now, it was a little bit different, as every single correction is not the exact same, because this massive wick to the downside, I'm not necessarily considering that the low in this scenario. I would consider the candle body closes, just because it was so manipulated and it was such a black swan event. So for example, the lowest low on the relative strength index is right here at 13. So we're just going to consider this candle body close as that low because, you know, the price was bought back up really quick from the market makers and the exchanges. And so then the higher low for the RSI was at 19 here. And then we put in a lower low on the price chart right here for Ethereum. Then we saw another higher low on the RSI, and we saw the lowest low on the price chart right here. So this was the bullish divergence, very similar to what we saw happen back here on the left-hand side of the screen. Lower low on the price chart, higher lows on a key indicator, plus we were in oversold conditions and we were recovering after dipping below 30. So this is a key thing to look for. And when you can spot confluence like this compared back to the past, then the recoveries tend to look pretty similar. So what I believe we're going through right now for Ethereum and the rest of the altcoin market is this recovery right here. So the real question then becomes, okay, well, how much higher does Ethereum go before we see this sell-off right here? It doesn't matter. What you want to watch is you want to watch these indicators and you want to look for confluence when we come back down below into oversold conditions. So on the stochastic RSI, that would be below 20. On the relative strength index, that would be closer to 50 or closer to 30 or even below 30. The RSI doesn't fluctuate as much as the stochastic RSI. That's why I love to use both. But right now, if we look at the stochastic RSI on the right-hand side of the screen, we're at 94 and 93. So yes, Ethereum could push higher in the short term, but eventually I would expect there to be some type of correction and then a continuation higher. Now, you can go into more micro time frames like the 15-minute or the 5-minute, and you can look for this bearish divergence on the 15-minute candles or the 5-minute candles to see when that correction would happen, and it'll give you better entry points. But I'm on the hourly right now to show you just a more macro picture here. If I were to go on the daily, it would show a completely different picture. But this is what I believe we're going through for Ethereum. And in my video 4 days ago for Bitcoin, this is what I said. So what I would expect in the short term for Bitcoin is a short-term bounce. And we'll see if it puts in a new high or if it gets rejected in this downtrend on a more micro time frame like the hourly. Even if we go into the 15-minute chart here, you can see the RSI is at 54, the stochastic is at 90 and 82. And so there could be a push to the upside, but then I would expect this to get met by some resistance and a sell-off further to the downside because we broke this uptrend here. So this would just be a retracement bounce for Bitcoin before we see a much larger sell-off. And then we need to finish up a downtrend looking for a bullish divergence before a major reversal back into price discovery. So don't get me wrong, I think Bitcoin's going to do well, but I think it'll look something like this before that takes place. And sure enough, that's what happened. We saw Bitcoin rally into resistance, get rejected from this descending resistance, and then just fail to reclaim the previous high. And then the liquidation event took place, coincidentally enough, right back down to these key levels of support that Bitcoin was at in September, at the tail end of September, and also back here at the beginning of September. So we come back into the zone, we retest it as support, and now everyone is freaking out thinking the world is ending, but yet people weren't freaking out as much when we were even lower back here at the tail end of August. So as aggressive as that sell-off was, it wasn't the end of the world, and now people are going to forget about it in a couple weeks from right now. I mean, even emotionally, do you feel a little bit different now if you were liquidating that event, or even if you weren't? Do you feel emotionally different as the price is breaking out right now? You probably do, but use logic here and understand that when bearish divergences start to form, then you have to be aware. So right now, we aren't seeing a bearish divergence, which tells me Ethereum is just going to keep marching up higher, closer to these levels up here, or Bitcoin in this case, around $120,000. This is what I would expect, Bitcoin to come up within these levels and face some type of resistance like this. Now, we'll see what the chart pattern looks like, but what I look for to see when this momentum rally is done and we go into a short-term correction to back test, maybe a previous resistance as support before continuing higher, whether it's this aggressive or, it's just a minor little consolidation before continuing higher, is I watch the relative strength index. I want to see the RSI form a high and then start to put in lower highs, whereas the price chart puts in higher highs. Once I see, the second, third, or fourth lower high between 50 and 70, then I know that the momentum is slowing down and we're going to see a pullback after an uptrend. So if you guys want to see these posts when I make them, then join our Discord group in the link below. We got about 1,000 people in this group. I even give you occasional examples of what this looks like. For example of a bullish divergence here or a bearish divergence would be when you see the price chart breaking out like this, and you look at the relative strength index, you see a loss of bullish momentum where the RSI struggles to reclaim 70 after we break a trend, and we see a retracement back into a lower high, similar to what I was explaining on Bitcoin's chart. On that retracement rally for Bitcoin, after it broke that downtrend there, then we saw a lower low on the relative strength index. So that's a sign that the bullish momentum is done and we're going to see a much bigger sell-off to the downside. Then we look for the opposite. We look for a bullish divergence. So As we get closer and closer to the top of the market, you guys can look at these charts on a more macro time frame like the monthly or the weekly, and you could see it playing out. Even right now for Bitcoin, if we just look at the relative strength index here on the weekly chart, you can see the RSI topped out here at 88 on the 4th of March, and it's been putting in lower highs ever since, whereas the price chart right here has been putting in higher highs ever since. Momentum is starting to slow down. So I do think there's another move to the upside for the final higher high for Bitcoin, and this will ultimately be the final lower high for the relative strength index. Now, the real question is if we break this downtrend, or if we do what I just explained right here in this example where the RSI has a loss of bullish momentum and it struggles to reclaim 70 and it tops out between 50 and 70 on the weekly, while Bitcoin's price chart makes a higher high, this would be a major warning sign, because if we see Bitcoin pushing upwards of 130, 140, and 150 and the RSI is not reclaiming 70 again, err on the side of extreme caution here, because this could be pretty much the end of the bull run. Now, I know that's not going to be what a lot of people want to hear, but it's what you need to hear, because if you're new to the crypto market and you haven't been here longer than, 2016 or 17, this is when I was getting into crypto almost 10 years ago. And I had to go through so many mistakes along this journey, and I've been focused on the crypto market, making content about crypto, researching the market every day. I mean, I researched the market for 8 to 12 hours a day for years on end, 7 days a week. And what I see on a daily basis is absolutely insane. The COVID crash liquidated $1.2 billion of capital. The FTX crash was $1.6 billion liquidated. Well, the most recent crash was $19.14 billion liquidated. It was the biggest wipeout in crypto history. And now we're seeing people just shrug it off like nothing happened. Even XRP right now, dropped $1.58, and now it's at $2.55. We're talking about billions of dollars flooding in and out in a matter of a couple days. This is absolutely insane. And XRP, in terms of daily liquidity, all downside liquidity was taking. All of the longs that had their stop losses at those levels were completely liquidated. It was a market reset. And this is what Michael Saylor recently said about the crash here.
This is kind of a historic entry point, because all of the risk has been stripped off the asset. Like, you pretty much know Wall Street's going to embrace it, the U.S. government's going to embrace it, and banks in the U.S. going to embrace it, which means that all the other banks will embrace it. You already know all those things, and yet the market is really skittish based upon concerns about tariffs, the disposition of the U.S. economy, the interest rate forward graph. And so you see the interest rates have pulled in 30, 40, 50 basis points. And we're in this macro risk off zone. When that flips, I think Bitcoin will rip forward with a vengeance.
So it's insane to see the whales running the same 2020 playbook, again, forcing everyone to sell before all of the altcoin ETF approvals take place is diabolical. We even made this post yesterday saying they crashed the market literally a week before the SEC has to decide on approving, or maybe they'll delay the XRP ETFs, but it's coming up within the week here. And then they get ready to pump the markets to the moon near the ISO 222 integration in November and take profits on the late buyers who FOMO in at the top. We've seen this time and time again, and this time it's most likely not going to be any different. Now, I thought this was a great post from TechDev saying it's never been the 4-year Bitcoin cycle. It's never been the Bitcoin halving. It's always been the business cycle that previously inflected every 4-ish years right near the halving. So Satoshi was genius enough to design this around the liquidity cycle, the business cycle. And how do you know this? Well, it's because it's also explained every other aspect of Bitcoin's chart. It's at a bottom right now, not at a top. Now, what does this mean? Well, let's discuss this and let's break down these key points right here. So the NASDAQ stock analog, which is not the index, this continues to track Bitcoin's movement with notable consistency. But what's most relevant about this analog isn't just its accuracy, but what it reveals about the evolving market structure. Now, if you look at the projection, we see what's described as a trunk up with fluctuations, which is a sustained upward trajectory where identifying definitive tops becomes considerably more challenging than in previous cycles, because like I mentioned, bearish divergences can continue for a period of time, whereas the price chart makes higher highs and the RSI just continues to make lower highs. Case in point was what I explained with Bitcoin's divergence on the weekly chart here for Bitcoin's dominance, because ever since October of 2023, we've seen Bitcoin's dominance make higher highs, whereas the relative strength index has just been continuously putting in lower highs. So this divergence has taken place. Even if we go into the daily, it's like over 600, 700 days, so it's a long-lasting bearish divergence. But the clear cycle tops we saw in 2013, 2017, and 2021 may give way to something more ambiguous. And looking back, there may even be disagreements about what constitutes the top. Because what I just mentioned here from CoinGlass with the bull market peak indicators are just part of the picture here. But they do add confluence to your overall macro investing or selling strategy when the markets finally do crash. So the two lines in this image right here marked on the projection serve as a reference point rather than definitive tops. They represent potential areas of significance within the broader upward structure. This evolution appears tied to the unusual extended business cycle turnaround we're experiencing, which is the longest in Bitcoin's history here. Now, while gold and copper remain central to this business cycle analysis, I thought this was really cool from TechDev because he's been researching ways to enhance its precision, adding the Dixie to the equation, the dollar, specifically using the MACD of copper, gold, and the Dixie to the second degree on the 6-week time frame. And this has yielded interesting results here because the bars flipping from red to green have consistently marked the beginning of Bitcoin's more parabolic phases. With the Dixie incorporated, we appear closer to this inflection than the 2-month copper to gold ratio alone would indicate. And the seasonality is worth noting. In both previous cycles, the August candle appeared just before the flip to green. The 2013 cycle flipped slightly later, but still followed the general pattern. And if September and October and November brings continual green bars as the pattern suggests, it would confirm this seasonality continuing. Now, the red band shows where cycles have historically topped, all within a relatively narrow range, and how quickly we reach this zone after the flip to green will be crucial for determining which path that we're on here in this bull market cycle. Because as you can clearly see, well, when we've topped in the past and we've been at green before going to light green, we're not anywhere close to that right now. And Ethereum's current setup when this picture was taken provided independent confirmation of our cycle positioning. The similarity to August of 2020 is striking, and that's precisely where the business cycle indicators suggest we should be. So this would play more into an extended market cycle theory rather than the 4-year market cycle. And we've broken out of a comparable range with similar internal structure other than this flash crash and this black swan event, but now it's getting bought up really quick. In the late August, early September pullback is playing out, and it could potentially have just finished up, and we could see a move now back into price discovery for Ethereum, which would only strengthen the structural parallel here compared back to 2020. And this isn't just a random correlation here. Ethereum is showing the structure at exactly the moment the business cycle framework suggests that it would. So the timing is strange, given Ethereum's tendency to lead broader altcoin movements and be like the weather map for alt season. This setup suggests that we're approaching a period similar to late 2020's expansion. So this brings me to path number 1. This would be the accelerated scenario. Now, path 1 would see a more rapid move into year end to Christmas time, similar to what we witnessed in early 2021, where the business cycle indicators surged directly towards the red zone. In this scenario, the green bars of the enhanced business cycle indicator would reach the critical red zone by Q1 of 2026, likely producing what would be called a corrective high later in 2026 rather than a definitive cycle top. And for Bitcoin, this could mean a move towards $180,000 by year end, followed by correction in early 2026 before another leg higher. Now, path number 2 would be the measured scenario, and it represents a more gradual progression where the 2026 targets don't materialize until well into 2026. And in this image right here, you can see the green bars of the enhanced business cycle indicator would progress more slowly, similar to 2017, not reaching the red zone until later in 2026. And this would produce a steadier ascent without the sharp correction implied by path 1. So if we see a drastic acceleration and the market's going parabolic by Christmas time, then err on the side of caution. But if we see a more steady climb to the end of the year, then scenario 2 might be more likely. So the key to distinguishing between which path we're on will be monitoring the velocity of the business cycle indicators over the next few months. In 2017, the green bars leveled off early in the year and took most of the year to reach the red zone. In 2021, they surged quickly to the zone in the first half of the year, and this difference in velocity determined the character of each year's price action. So what we're going to be watching is number 1, the green bar progression speed. Rapid movement towards the red zone suggests path number 1. Measured progress indicates path number 2. Well, number two, global liquidity dynamics too. The 11-week forward correlation should provide early indication of which scenario is more likely developing. And then number three would be the altcoin market behavior. So the intensity of the initial expansion will offer clues about which path is manifesting depending on the speed, how quickly we go to the upside, and how intense it is by the end of the year. So by the end of this month, we should have enough data to determine which path is more likely. And the confluence of signals from the enhanced business cycle framework to Ethereum structural alignment confirms we're at a very important inflection point here. And the question isn't whether we're headed higher, but rather the path we'll take to get there. And both scenarios lead to similar destinations, just via different routes. Path 1 offers a more dramatic journey with clear entry and exit points and a really fun fireworks show and a blow off top. Path 2 suggests a steadier progression requiring more nuanced position management and patience here. And the NASDAQ analogs continuation reinforces that we're likely entering a period where market structure differs from what we've grown accustomed to. Even though there's going to be some similarities to the past, it's obviously not going to be the exact same. So identifying tops will become very, very challenging. And in retrospect, there may be disagreements about what even constitutes the top versus just another fluctuation in the broader ascent. And when the bear market finally starts, it's going to take some time, because even looking at the S&P 500 index for where we're at right now, we saw this pullback. The markets are going to open tomorrow because it's Sunday right now. But look at this, from 6,700 to 6,500. Zoom out. This is nothing for a pullback compared to what we went through here back from 2000 to 2003. So to go from top to bottom back at that time frame, it took over 926 days. So that's like 2 to 3 years, pretty much, almost 3 years there. So it doesn't happen in a matter of 24 hours, although these sell-offs can be pretty scary in a 24-hour period. Look at how many sell-offs there were before we even reached the top in this distribution phase back here. Even if I trace up the chart from the past for that 2000.com bubble boom, it's pretty scary how similar the pattern is. Almost to the T. It's virtually identical here. Even this like V-shaped sell-off in this recovery right now, or what we're going through right now, is really just a macro distribution phase before the top comes in. And so the real question is, do we top, by the end of this year, 2025, or do we top closer into 2026 before we start the descent going into 2027, 2028, 2029, and then we have to make a recovery, after a 2, 3, 4 year period? Because a lot of people are arguing, the biggest billionaires in the world, that this recovery is just going to be like a decade or two of sideways choppy price action, somewhat similar to what we went through in the 80s. Now, I wasn't alive during that time frame, but for those of you that were on the channel, maybe you guys do remember this period, where before the 80s, it wasn't in the 80s, it was actually like right here from 1968 until 82. So, almost 20 years, price didn't really do anything, went up 30%, but it took 5,000 days to do that. And in the meantime, we saw these massive sell-offs, of 35%. And then the market goes in rallies over the course of 1,000 days for 74%. And then we see another sell-off right here, 47% over the course of 669 days. And then we see another rally up here of 75% over the course of 825 days. Then we see another sell-off of 18% over 500 days. And then the market rips to the upside. So we have gone through one of the most aggressive bull cycles in history for the stock market on the more macro time frame. So in my opinion, based on this data here and what I'm seeing on the chart, I would not be surprised if what we're going through right now is just like a macro distribution phase, and we go through a major sell-off, then we go through like a decade or two of choppy price action before the stock market continues higher. And then by then, ultimately, all of this liquidity here is just going to be rotating over to the crypto market, because the crypto market is like what the stock market once was for my generation and the kids that are younger than me, all the way back here in the early 1900s. I mean, we're in 2025. So like imagine 1925, all the way back here, we saw this blow off top, and then we saw this correction. So we could be going through this right now for the crypto market, and we're pretty much like right here or right here near the top. And then we go through this sideways consolidation, and like 2030 is the real establishment bull cycle on the recovery. Then we go into another bear market. Then by like 2040, 2050 and beyond, we see the crypto market really start to melt faces and do something like this. This is what I would actually expect. So by the time I'm like 60, 70 years old, well, then the crypto market's going to be up here, and then like passing down for future generations is when the crypto crypto market does what the stock market did, after the 1980s. So over the course of 20, 30, 40 years. So if I live to be 120 years old, maybe I'll see the fruits of my labor in these videos that I'm making right now for you guys. But nonetheless, I think we're going through a major distribution phase right here in the stock market. So we'll see how much higher we go. But what's the best plan and what can you do to be able to protect your capital during a bear market? Well, that's discovering how to earn passive income on your crypto, because if you have 10K or more in crypto, you're literally giving up an extra $300 per month in passive income. You're giving up on a free 3 to 8% additional monthly yield just because it's sitting on an exchange like Coinbase or Binance and you're being lazy. You're taught to hodl, just wait for price appreciation, and this is costing you thousands of dollars. So let's see what happens here. While your assets are sitting there doing absolutely nothing and inflation is kicking your ass. For example, Ethereum didn't do anything over the course of 3 months. XRP didn't do anything over a whole year. And Solana, same thing. It didn't do anything for an even longer period of time while you sat there making no money. And I'm not saying that these are bad investments. It's quite the opposite, actually. But the smartest investors in the world make their crypto work for them to generate additional yield. And why would you not do that? You're holding these crypto assets anyways. It's like buying a rental property and not renting it out. If you hold on to the property because you believe that it's going to appreciate in value over years, why wouldn't you rent it out so someone else can pay your mortgage while you still get the value appreciation? So it makes no sense to just hold your crypto without earning yield on your idle coins. And if you're just holding your crypto on exchanges like Coinbase, your assets aren't safe. In fact, Coinbase was hacked for $400 million and the hackers bribed Coinbase employees so they could access sensitive user information, demanding a $20 million ransom from Coinbase, which the company refused to pay.
I want to make you aware of a disturbing email that we received recently at Coinbase. It was a ransom note demanding $20 million in Bitcoin in exchange for these attackers not releasing some information they claim to have obtained on our customers. I'm going to respond publicly to these attackers by saying no. We are not going to pay your ransom.
And I even received a letter in the mail saying that my information was included in that hack. So I'm speaking from firsthand experience here, not just an article that I read online. So not only are you leaving free money on the table by not earning yield on your idle crypto, but you're also putting yourself at risk of losing it all, getting hacked, or having your account frozen by keeping your crypto on centralized exchanges. Because if it's not your keys, it's not your crypto. You already know this, so I don't have to tell you. You can't afford to be lazy with your capital. The US is drowning in nearly $40 trillion in debt, so this is your insurance against the system. To learn how you can earn passive income on your coins every single day while protecting your capital from hacks or scammers, my research team put together a step-by-step tutorial for you to start earning yield on your crypto today, and it takes less than 10 minutes to get set up. All you need to do is go to altcoinpro.com after you're done watching this video, create your account, and click on the Start Here lesson under the classroom, and you'll discover how one liquidity pool is earning our members up to 40% yield on digital assets that they already own. Plus, you can go into the DeFi yield picks and see even more opportunities to earn passive income on your coins safe and predictably with complete control and ownership of your assets. You will make significantly more money by being your own bank. And all you need to do is go to altcoinpro.com to get started right now.